Okay, let's unpack this. Few companies generate the kind of passionate, polarized debate that Tesla does.
Absolutely.
For years, the market has been trying to figure out where exactly this company fits. Is it an overly valued, volatile car manufacturer, sometimes called the Detroit of the future?
Right.
Or is it truly a futuristic AI and robotics powerhouse, kind of on the verge of world domination, more like an Amazon or a Google?
And that conflict isn't just theoretical anymore, is it? It's screaming from their financial statements,
Yeah.
especially ahead of their next earnings call. We've got this incredible stack of documents, specifically the recent Q2 2025 Form 10Q filing, which gives us the cold, hard financial facts about their core business.
But at the same time,
But simultaneously, yeah, the strategic narrative continues to pivot aggressively toward autonomy and, the multi-trillion-dollar robo-taxi vision.
that is the mission today, then, to provide you, the learner, with the factual building blocks needed to cut through the immense market noise. We need to dissect this fundamental contradiction. Is the recent surge in TSLA stock price? And let's remember, it has an astronomical beta of 2.08, meaning its volatility is more than double the broader market.
Yeah.
Is that justified by that massive long-term AI potential?
War.
Or is the near-term financial reality, the margin contraction, the revenue decline, the surging legal risk, is that the true signal we should be paying attention to right now?
It's a high-stakes deep dive, definitely.
Mm.
Because the financials paint a picture of, operational stress.
Yeah, stress is a good word for it.
Even as management is pouring capital into a future that could fundamentally change the global transportation model, we have to look at both stories simultaneously and understand the precise financial mechanisms that allow them to fund this pivot.
Okay, so let's start with the present reality then. Let's look at the operational foundation, the core automotive business, using the 6 months ended June 30, 2025 from that 10Q.
Right.
When we look at the top line, the story is, well, it's anything but a growth narrative, isn't it?
No, the shrinkage is undeniable. Total revenue for the first half of 2025 decreased by 11%.
11%.
It dropped from $46.80 billion in the first half of 24 down to $41.83 billion this year.
Okay.
And if we narrow that focus just to the second quarter of 2025 alone, the decrease was even sharper, 12%,
Wow.
hitting $22.5 billion versus $25.5 billion the previous year. This isn't just a slowdown. It's a clear reversal of their previous growth trajectory.
Right.
And it's having a cascading effect across profitability.
And the lion's share of that decline isn't coming from the energy side, right? That actually showed some growth.
That's right. Energy generation and storage did okay.
It's the engine room of the business, the actual automotive sales division, that's faltering. What was the magnitude of that decline and what specific factors caused it?
Automotive sales revenue experienced a severe 18% drop over that 6-month period.
18%, that's significant.
It really is. And the sources trace the weakness back to a combination of volume loss and pricing pressure.
Okay, let's break that down. Volume first.
On the volume side, they delivered approximately 95,000 fewer Model 3 and Model Y cash delivery units combined.
95,000 fewer cars.
Yeah. Management specifically cited simultaneous factory changeovers for the ramp-up of the new Model Y as a significant contributing factor. So some of that was planned temporary disruption cutting volume.
Okay, so a strategic planned hit to volume from retooling. That makes some sense. But we know the market environment has also gotten much tougher, right? What was the second major factor driving that 18% drop?
That would be pricing pressure, or what the financial statements refer to as a lower average selling price per unit, the ASP.
Ah, the ASP.
And this wasn't just due to the sales mix, which models they sold more of. Crucially, it was due to higher customer incentives,
Such as?
including offering far more attractive financing options. When a company relies on incentives like that to move inventory, it eats directly into the revenue captured per car.
So they're sacrificing price?
Essentially, yeah. They're sacrificing price to keep the delivery volume from sinking even further in what's become a fiercely competitive global EV market.
That immediately leads us to the core vulnerability for traditional investors, doesn't it? The margin squeeze.
Exactly.
If revenue is falling and you're forced to offer deeper discounts, the gross margin is the first thing that gets hammered.
Precisely. The total automotive gross margin contracted significantly. It fell from 18.5% in the first half of 2024.
Which wasn't exactly stellar to begin with.
No, but it fell down to 16.8% in the first half of 2025. Now, the cost of automotive sales revenue did decrease, meaning they're getting cheaper materials maybe, increasing efficiency.
Okay, some cost savings there.
But that cost decrease was simply not potent enough to offset the double whammy of falling revenue and lower ASPs.
Right.
So the margins are being squeezed, not just by lower selling prices, but also by lower fixed cost absorption because their production volumes were temporarily lower.
Due to those factory changeovers.
Right. And the company noted an increase in tariffs compared to the prior period. So multiple pressures hitting margins.
I have to challenge this point for a moment, though. When a company continually sacrifices its margins like this to maintain volume, isn't that just admitting they've lost the pricing power war?
No.
It sounds like the classic Detroit problem, having to heavily discount cars to clear the lot, not the disruptive Silicon Valley model we've heard about for years.
Well, that is the bear case, absolutely. And the data does suggest that in the traditional auto market, their brand premium might be eroding, forcing them to compete directly on price against established automakers and, increasingly, those aggressive Chinese EV players.
Okay.
However, management's counter-argument, we'll dive into this more with R&D, is that they view the vehicle hardware as an increasingly necessary sort of low-margin platform upon which to layer future high-margin software revenue. That's a pivot.
Okay, that software revenue pivot. It relies heavily on what was, until recently anyway, a sort of hidden source of pure profit. Regulatory credits. But segment 1 here reveals this revenue source has hit a massive headwind.
This is a critical nuance, for understanding just how severe the gross margin contraction really is. Revenue from automotive regulatory credits decreased massively by a whopping 51% in Q2 2025 alone.
51%.
Dropping from $890 million down to $439 million year over year. That's almost $500 million in quarterly revenue.
Wow.
Essentially vanishing overnight from a stream that had almost 100% margin. Pure profit, basically.
Half of that easy margin-boosting income gone. Why the sudden sharp drop? What happened?
The 10Q explicitly ties this revenue crash to governmental and regulatory actions that have either repealed or restricted certain credit programs. They're quite specific about it.
Okay.
The filing notes this contributed to a significant $1.11 billion decrease in remaining performance obligations, or RPO, just since March 31st, 2025.
Okay, let's unpack that RPO detail for the listener. RPO is essentially contracted future revenue, right? Money that other companies were guaranteed to pay Tesla for credits they needed later.
Precisely. So the insight here is that Tesla didn't just lose revenue this quarter. They lost over $1 billion in guaranteed future income from this source.
That signals a structural change then, not just a blip.
Exactly. It means policy headwinds are dramatically suppressing their ability to sell these credits to other automakers who maybe don't need them as much anymore, or the programs are changing. It's not just a cyclical drop. It seems like a permanent suppression of a vital high-margin revenue source due to shifts in global EV policy and perhaps the increasing number of compliant competitors.
So we've established the foundation is, well, cracking a bit. Falling revenue, tighter margins, and a regulatory credit shock.
Yeah, that sums it up.
Now let's shift our attention entirely to the scaffolding of the skyscraper they're trying to build on top of this. Because despite the stress on the core auto business, management is aggressively opening up the wallet for the future.
Right, this is where it gets really interesting.
Let's look at the massive surge in R&D spending. This seems to confirm the shift in financial focus entirely to AI and technology.
The R&D jump is the clearest, most measurable financial signal that this company has shifted its primary identity, I think. R&D expenses increased a stunning 48% in Q2 2025.
48%.
Climbing from $1.07 billion to $1.59 billion year over year.
Just in one quarter.
Just in Q2. And to put that in perspective, R&D expenses have jumped as a percentage of overall revenue. They moved from 4% in Q2 2024 up to 7% in Q2 2025.
So a much bigger slice of a smaller pie is going to R&D.
Exactly.
That $500 million quarterly increase funded while the core business is contracting.
Yeah.
That's enormous. What is the explicit management direction for this capital? Where is it going?
The filing says the increase is primarily due to costs related to AI and other programs.
Okay, so direct confirmation.
Yeah. This is the core investment into autonomy, the FSD software stack, and that fleet-based profit model they envision. This massive capital dedication to R&D, even while sales revenue is declining, it really underscores that loss leader platform strategy we touched on. Management is essentially using the company's strong valuation and balance sheet to treat the automotive division as a necessary platform, maybe, to buy future high-margin software revenue.
They're prioritizing the AI dream.
They are prioritizing the exponential potential of AI over present low-margin hardware profitability. Seems clear.
But pouring money into R&D while core business revenue is falling raises the obvious concern, doesn't it? Are they burning through their cash reserves to fund this high-stakes AI race?
That's the natural question, yeah.
Does this R&D spend threaten their immediate financial stability?
Surprisingly, the answer seems to be a resounding no. The company maintains an exceptionally strong balance sheet and solid liquidity.
Okay.
As of Q2 2025, they had $36.78 billion in cash equivalents, and investments. That's a lot of cushion.
36 billion, okay.
Furthermore, net cash provided by operating activities actually increased.
Increased, even with lower profits.
Yeah, increased by $842 million in the first half of 2025, reaching $4.70 billion.
Okay, that increase in operational cash flow while net income declined seems financially contradictory. That's quite a move. How did they achieve that positive cash flow generation?
It was primarily driven by favorable changes in working capital and, frankly, superior balance sheet management.
Okay, working capital. Explain that a bit.
Well, the sources emphasize better working capital efficiency. That's a technical detail, but really important. They've managed to shorten their days sales outstanding, DSO.
Meaning they collect money from customers faster?
Right, while at the same time stretching their days payable outstanding, DPO.
Meaning they take longer to pay their suppliers?
Exactly. This maneuver essentially generates immediate operational cash flow. It pulls cash forward,
Got it.
which conveniently offsets the dip in net income caused by falling margins. It's a key reason why their financial health remains robust enough to fund that $1.59 billion quarterly R&D bill.
So they have the financial firepower to endure this pivot, at least for now. The liquidity metrics certainly confirm this ability to handle short-term liabilities.
Absolutely. The current ratio stands at 2.04.
Meaning they have over twice the current assets to cover current liabilities. Pretty healthy.
Very healthy. And crucially, the debt-to-equity ratio is extremely low at 0.07.
0.07, so hardly any debt relative to equity.
They are not leveraged significantly. They have the financial resilience, it seems, to manage the immediate pain of the auto cycle while funding this aggressive AI pivot.
Okay. Now let's discuss future spending and the very noticeable inventory buildup. We saw lower CapEx year over year in the first half of 2025, but the full-year forecast looks massive.
Yes, the 6-month CapEx was $3.89 billion, which was lower than the prior year. But this was likely just a strategic pause, maybe related to those factory changeovers.
Okay.
They currently expect full-year 2025 CapEx to exceed $9.0 billion.
$9 billion plus.
Yeah, and this massive figure is geared toward exactly what you'd expect. AI-related assets like compute power, global factory expansion, and accelerated battery cell technology development. It reflects an acceleration plan for the second half of the year.
Makes sense. And then there's the elephant in the financial room. The finished goods inventory. That figure jumped sharply.
It really did. Jumped to $6.39 billion from $3.94 billion at year-end 2024.
That is an enormous buildup of finished, unsold vehicles, over $6 billion worth.
It is, and it presents an immediate, tangible risk. You can see it in the numbers. The inventory write-downs have already significantly increased.
So much.
They hit $210 million in the first half of 2025, up sharply from $68 million the prior year.
Ouch.
That expense signals obsolescence or, net realizable value concerns if those cars sit too long on the lot, unsold. This $6.4 billion inventory figure is the central point of contention for many analysts ahead of earnings.
Hold on, is that inventory risk genuinely just risk? Or is management simply trying to put a Silicon Valley spin on an old Detroit problem, which is classic oversupply?
That is the ultimate question for investors, isn't it? Is this massive inventory a sign of immediate oversupply risk in the traditional auto market? Does it prove the bear case that they just can't sell cars fast enough at profitable prices anymore?
Or is this, as the bulls argue, the necessary hardware float?
Right.
Cars just sitting ready, waiting to be activated.
Like soldiers waiting for orders.
Kind of. Yeah. Waiting to monetize the high-margin robo-taxi software once full autonomy is unlocked. This inventory is either a massive liability dragging them down,
or a massive future asset base ready to generate service revenue.
Exactly. It changes the entire narrative depending on which angle you take.
If FSD is perfected tomorrow, that inventory is gold. Pure gold.
All right.
If FSD is delayed another 3 years, that inventory is a huge drag on profitability. stale tech, maybe?
Exactly. It crystallizes the entire investment thesis, really. It's betting on the date when that software switch is finally flipped.
Okay, the financial numbers are messy. They definitely reflect a company caught between two distinct business models.
Very much so.
But the legal and regulatory landscape is a potential minefield. It could derail the pivot regardless of technological progress.
That's a huge overhang, yeah. For any investor evaluating the risk ahead of earnings, you have to consider the substantial legal headaches facing management. Let's start with the headline-grabbing CEO compensation package.
Ah, yes, the 2018 saga continues. The litigation relating to that massive 2018 CEO Performance Award is far from resolved.
Right.
And the potential implications, both financial and maybe even operational, are massive. The Delaware Court of Chancery found that the award should be rescinded.
And then Tesla tried to get shareholders to ratify it again.
Correct. And the court subsequently denied Tesla's attempt at that stockholder ratification in December 2024. So, strike two.
And the court-awarded fees associated with this failure are just staggering. It points to the immense cost of this governance risk.
Indeed. The court awarded the plaintiff's counsel fees in the amount of $345 million.
$345 million, just in legal fees for the plaintiffs.
Just for the plaintiff's lawyers, yeah. Tesla and the director defendants are currently appealing these decisions to the Delaware Supreme Court.
Okay, so it's still ongoing.
But the explicit risk noted in the 10Q filing is a potential material adverse impact on the business and reported earnings if that appeal fails.
Which means it could hit the bottom line hard.
Potentially, yes.
Right.
And beyond the financial penalty, the uncertainty surrounding the CEO's compensation and, leadership structure could disrupt the aggressive AI pivot strategy itself. Distraction, uncertainty.
Good point. Speaking of director compensation, there was a separate settlement recently approved by the court regarding compensation awards granted to other directors. What was the net financial impact there, and what does it tell us about legal overhead?
That settlement, approved in January 2025, saw Tesla receive $277 million from certain directors, which, sounds great on the surface.
$77 million back to the company.
But the company then had to pay a stunning $176 million in legal fees to plaintiff's counsel.
$176 million in legal fees just to settle that related compensation dispute.
Wow. It's an insight into the staggering cost of this kind of governance litigation. The net financial impact to additional paid-in capital from the equity transaction was only about $101 million.
So they netted $101 million, but paid out $176 million in fees.
Well, the $277 million came from the directors. The $176 million went to the lawyers. The net cash impact is complex, but the fee itself is enormous. In fact, Tesla has actually appealed the amount of that legal fee award itself.
They're appealing the fee.
Yeah, arguing it's excessive.
Yeah.
But the underlying settlement terms, which included the cancellation of certain options, remain in place.
Okay. Beyond executive compensation, the core technology that underpins the whole $10 trillion Vision Autopilot and FSD, that's under intense legal and governmental scrutiny right now.
That's right. And this is maybe even more critical. There are multiple proposed class actions alleging misrepresentations and defects concerning autopilot and full self-driving capability.
Right, we hear about these all the time.
While many individual cases have been dismissed or compelled to arbitration, which does limit the company's liability somewhat.
Arbitration keeps it out of big public trials.
Correct. But there are still active motions underway in consolidated federal court. These haven't gone away.
And what is the immediate risk there? I hear the term class certification being thrown around. What does that actually mean for Tesla? Why is that important?
That is the critical factor. A crucial class certification hearing in the consolidated action in the Northern District of California is scheduled for August 12, 2025.
August 12th, so coming up soon.
Relatively soon, yes. If that class is certified,
Well, often done.
then the gravity of the liability moves from, say, a handful of individual suits, which they can manage, to potentially millions of vehicle owners alleging harm or misrepresentation.
Millions.
Potentially. The financial impact, the legal overhead, and the potential damages could increase exponentially. It threatens the entire FSD revenue model if they're found liable on a class-wide basis.
That sounds like a huge potential risk. And it's not just private lawsuits, is it? They are cooperating with multiple high-profile governmental investigations right now.
Yes. The 10Q mentions they routinely receive information requests and subpoenas from agencies that cover the full spectrum of risk. You got NHTSA.
Focused on vehicle safety and incidents.
Right. Then the SEC.
Investigating disclosure and financial reporting related to the technology, presumably.
Exactly. And the DOJ.
Focused on potential criminal or fraudulent misrepresentations.
Correct. So when all three, safety, financial, and legal enforcement, are scrutinizing the FSD and robotaxi programs simultaneously, it signals a systemic risk that investors really cannot ignore.
It's a multi-front regulatory battle.
It certainly seems that way.
And finally, on the regulatory front, we need to address the new legislation impacting the sector. The U.S. H.R. 1, referred to as the OBBA, enacted on July 4th, 2025. This sounds like it compounds the existing regulatory credit pressure we discussed earlier.
It does. The OBBBA, which we can understand here as the Omnibus Battery and Business Balancing Act, quite a name. It's a major source of potential headwinds they're still evaluating. It includes the repeal, or sort of sunset acceleration, of certain tax credits originally provided under the 2022 Inflation Reduction Act.
Rolling back some of the IRA benefits.
Potentially, yes. The explicit implication mentioned is a loss of certain future regulatory credit sales hitting that revenue stream again.
Right.
It could also mean higher battery cell expenses due to supply chain restrictions, potentially, and maybe a likely overall reduction in consumer demand for electric vehicles generally because of diminished incentives.
So less government help for EVs overall.
That seems to be the concern. This policy risk adds significant weight to the existing challenges in the core automotive business. Another headwind.
Okay, so let's try to leave the minefield of legal risk and operational pain behind for a moment.
If we can.
And look at the audacious strategic shift that forms the backbone of the entire bull case. And frankly, it's what justifies that sky-high PE ratio for many.
Right. This is the why.
In June 2025, Tesla officially launched its robo-taxi service, known as Cybercab, in Austin, to a limited group of users. This is where the whole narrative changes, isn't it? Moving from selling low-margin metal...
The selling high-margin software access.
Exactly. This Cybercab launch is the definitive strategic pivot we've been tracking financially. Management is executing a shift from generating revenue through those one-time low-margin hardware sales
Selling a car once.
to recurring high-margin revenue delivered through a service-driven mobility-as-a-service model. The entire $1.59 billion quarterly R&D spend we talked about.
Okay.
It's flowing directly toward making this scalable mobility infrastructure a reality. That's the target.
We have to put this market opportunity into perspective, though. When analysts talk about this, the numbers are so large they almost become meaningless,
Staggering.
What is the true scale of this vision using analyses from firms like ARK Invest?
Okay, the numbers require a moment of awe, maybe.
Yeah.
ARK projects the global robotaxi market could reach approximately $10 trillion.
$10 trillion. Trillion with a T. That is more than the GDP of entire major industrial nations.
Wow.
This is the fundamental basis for the stock's entire valuation, or at least the bull case for it. Their analysis suggests that Tesla's robotaxi business alone could represent about 90% of its total enterprise value by 2029.
90% of the value coming from a service that just soft-launched a few months ago.
Exactly. It's all future potential priced in. And they project that the current annual global production of Model 3 and Model Y vehicles could already support the vehicle miles traveled, VMT, of any top 10 U.S. urban market.
So they have the cars.
They have the underlying capacity, the hardware float we discussed, potentially ready to go.
But Tesla isn't operating in a vacuum here. Waymo is the established player, right? Backed by Google Alphabet.
Correct.
How does the competitive dynamic look right now? What's Tesla's challenge against Waymo?
Waymo is certainly ahead in deployment maturity, no question there. They are conducting over 250,000 fully autonomous paid rides per week.
250,000 rides a week. That's real volume.
It is. And their safety records are approaching the U.S. human accident rate, roughly 1 accident per 700,000 miles, which is impressive. Waymo has been scaling gradually since 2018, meticulously mapping and geofencing their operating areas. Very careful, methodical approach.
And Tesla is approaching this challenge with a very different strategy, aren't they? It's rapid scaling, vision only, relying almost entirely on generalized AI.
Correct. Tesla is pursuing rapid scaling with a vision-only end-to-end AI approach. They're skipping the expensive LiDAR sensors and the detailed mapping reliance of Waymo.
More scalable, potentially riskier.
That's the trade-off, potentially. Despite launching just this summer, Tesla rapidly matched Waymo's operating region size in Austin, apparently. That illustrates the speed of their software-based deployment potential. The race is really about which model achieves generalized autonomy first and can scale faster.
Okay. Now let's identify the three key competitive advantages that, according to the sources anyway, are positioned to allow Tesla to dominate this $10 trillion market over time. Let's start with manufacturing, the aspect where they look the most like a traditional company.
Right. The first advantage is vertically integrated manufacturing. Tesla's ability to scale vehicle production is just unmatched by any tech competitor. They produce over 5,000 vehicles per day globally.
5,000 a day.
To help the listener visualize this scale, their Austin factory alone could theoretically build that city's entire existing ride-hail fleet in roughly 9 days.
9 days to replace every Uber-Lyft car in Austin.
Hypothetically, yeah, based on production capacity. Waymo relies on manufacturing partners like JLR or Stellantis. Tesla controls the entire supply chain, offering unparalleled scale and potentially better quality control.
And they have specific plans for the Cybercab itself.
Yes, Tesla plans aggressive Cybercab production, targeting 2.4 million units annually starting next year. That's a clear, overwhelming scaling advantage on the hardware side.
Okay, advantage one, manufacturing scale. The second advantage speaks directly to the AI titan half of the narrative, the data engine.
Absolutely. This is crucial. Tesla has an exponential data advantage. According to research, Tesla gathers approximately 900 times more real-world driving data from its global fleet than Waymo does.
900 times.
That's the estimate. This enormous data foundation feeds their AI, enhancing its ability to handle edge cases, weird situations, unexpected things.
Think it's not on a map?
Exactly. Without the need for the painstaking, detailed, geofenced mapping that Waymo relies on. This data pool is the key, they believe, to achieving true, generalized autonomy across diverse geographies quickly.
Because Waymo's maps limit where they can operate easily.
Right. Waymo's reliance on specific maps makes their service hard to scale globally rapidly. Tesla's vision-only approach, fueled by this massive data advantage, is designed for rapid global deployment in theory.
Okay, data advantage is number two. Finally, let's look at the financial advantage. Autonomy only wins if it's fundamentally cheaper than human drivers or existing autonomous competitors like Waymo.
Right. The third advantage is cost per mile. When operating at scale, Tesla's cost per mile is projected to be 30% to 50% lower than Waymo's.
30 to 50% cheaper. How?
This is the direct result of avoiding LiDAR and other specialized, expensive hardware required by competitors like Waymo. Their vision-only approach, using cameras and AI, provides a clear path to drastically undercutting competition on price.
Which is essential.
Absolutely essential for market dominance against both human-driven services like Uber and Lyft and other autonomous players.
Wait, let me interject here, though. This critical cost advantage relies entirely on the vision-only approach succeeding, right?
Yes, fundamentally.
But isn't that same vision-only technology, full self-driving, the primary source of the governmental scrutiny and the massive class action lawsuits we just discussed in segment 3?
That is the ultimate fragility, the Achilles heel, perhaps, of the bull case. You nailed it.
Okay.
The legal risk fundamentally threatens the cost advantage. If the regulators or the courts force Tesla to add specialized sensors like LiDAR, or if liability costs rise dramatically due to the class actions,
Then the savings disappear.
the 30–50% cost savings could evaporate, undermining the entire path to market dominance. The bear case argues that the legal risks make the cost advantage thesis unsustainable long-term. The tech has to work and be legally acceptable.
So what does this all mean for the investor facing the upcoming earnings call? It's a lot to juggle. We have a financially shrinking core automotive business,
Jack.
countered by an explosive multi-trillion-dollar AI potential,
Check.
all wrapped up in a massive package of legal and regulatory risk.
Check. It's quite the mix. And this irreconcilable conflict is perfectly reflected in the analyst community, isn't it?
It really is. What are the analysts saying?
Well, the analyst community is deeply, viscerally split. We're tracking 45 Wall Street analysts covering Tesla, and the consensus rating is a flat, non-committal hold.
Just hold. Doesn't tell you much.
Not really.
Yeah.
You have 23 buy or strong buy ratings, so almost half are bullish, but then you have 12 hold and 10 sell ratings. That kind of distribution just screams massive disagreement about the company's fundamental valuation and future.
And the consensus price target reflects that extreme volatility too, right? It's actually predicting a significant downside from the current price.
Precisely. The recent closing price we looked at was $439.31. But the consensus price target among those 45 analysts is $363.54.
Oh, jeez.
A significant 17.25% downside potential baked into the average analyst view. And the range of targets is utterly extreme. It really reveals the scale of the debate. The lowest target is a shocking $19.05.
$19.
Yeah, basically arguing the valuation should revert to that of a struggling automaker, maybe even bankruptcy risk priced in there, all the way up to a bullish high target of $600.
$19 to $600.
Wow.
That's not consensus, that's chaos.
It's pure polarization. And we've seen this volatility in action recently. You had firms like UBS setting a low target of $247, while Wedbush boosted their target all the way up to $600, purely on the back of the robotaxi progress and potential.
Yeah.
Shows how different analysts weigh the present versus the future.
Okay, so let's summarize the key pillars underpinning the current bull case then. What justifies that $1.43 trillion valuation for the bulls?
The bull case highlights the sheer potential that the current financials are, in theory, funding. They point to the strong liquidity, that $36.78 billion cash pile, and the low financial risk from the balance sheet, current ratio 2.04, GE 0.07.
Solid foundation.
But fundamentally, the argument hinges on the leverage provided by that $10 trillion robotaxi opportunity and the massive accelerating investment in AI and robotics. The 48% R&D increase confirms management's commitment.
So it's a bet on the future.
It's betting on future exponential revenue derived from high-margin software, arguing that the current automotive business contraction is simply the cost of doing business during a necessary platform transition.
Yeah.
Growing pains for a tech giant, not the death throes of an automaker.
Okay. Conversely, the bear case. It focuses almost entirely on the reality of the traditional business model and valuation metrics that seem completely out of whack with that reality.
Exactly. The primary argument for the bears is the extreme valuation risk. That PE ratio currently sits somewhere between 248 and 254, depending on the exact calculation.
250 times earnings.
That figure is almost impossible to justify based on current earnings or traditional manufacturing growth rates. It prices in perfection, maybe beyond perfection.
Well, and then they add.
Combine that PE with the contracting core automotive margins, the significant revenue decline of nearly 12% year over year, the increasing inventory write-downs we saw.
The $6.4 billion inventory pile.
Right. And the persistent legal and regulatory risks, the CEO compensation lawsuit potentially coming back, the FSD litigation, and that upcoming class certification hearing, plus the structural impact of the OBBA legislation may be hurting demand and credits.
So the bears say.
They argue the bottom could drop out when the growth narrative hits the harsh reality of their current gross margins and mounting risks. It's priced for a future that might not arrive, or might arrive much later, or be much less profitable than expected.
It's the ultimate paradox, isn't it? The volatility, that high beta of 2.08, is merely the financial reflection of a market trying desperately to decide if it's valuing a car company or an AI future.
Exactly. And the coming earnings call will be all about how management frames these conflicting signals. Which story do they emphasize? Hashtag #OutTrackOutro. So to synthesize the entire picture we've painted here, we've established that Tesla is experiencing substantial and measurable financial pressure in its foundational automotive business. That's driven by lower average selling prices, margin contraction, the plunging regulatory credits revenue.
The course is stressed.
Definitely stressed. Simultaneously, management is executing an aggressive, highly capital-intensive pivot toward AI, robotaxi development, and energy. That's underscored by that massive 48% increase in R&D spending.
Pouring money into the future.
Right. The company is financially healthy enough, it seems, to afford this pivot for now, thanks to its cash pile and balance sheet management. But the profitability of their core business is definitely suffering in the process.
So what does this all mean for you, the learner, watching the upcoming earnings call? The narrative will be dictated by how management frames these two conflicting stories. The contracting present versus the potentially explosive future.
And that brings us back to one single provocative detail that we need you to keep front of mind as you listen to the news unfold from the earnings call and beyond.
What's that?
Look closely at that massive $6.39 billion finished goods inventory buildup, that pile of cars.
Okay.
Ask yourself, is that massive inventory a sign of immediate oversupply risk and traditional auto market weakness, proving the bear case that they just can't sell cars fast enough profitably right now? Or is it perhaps simply the necessary hardware float, the hundreds of thousands of vehicles sitting ready, like you said, soldiers waiting to be activated, ready to monetize the high-margin robo-taxi software once full autonomy is unlocked?
Viability or launching pad.
Precisely. Which perspective dominates the coming quarter's narrative and the market's reaction will determine whether TSLA trades like a stressed automaker, maybe justifying a much lower PE.
Or the multi-trillion-dollar AI titan it aspires to be. It's a classic battle between present reality and future potential.
And the true answer, as always, likely lies somewhere frustratingly in the middle.
Indeed. Keep those financials close. Keep these dynamics in mind as you listen to the narratives unfold.
Absolutely.
A huge thank you for joining us for this deep dive into Tesla's contrasting realities. We'll catch you on the next one.